Hi guys, welcome to Paradox of a Losing Cycle channel. In this video, we're going to be talking about a case study on a $150,000 ruin in 3 days in Forex day trading. Now, this is based on a real story and it's a real account. It was, um, it's a story by an expat. Uh, Basically, he was married with two kids, and he saved about $150,000 within about 20 years lifespan. And he met a broker, a Forex broker, over a coffee, and the broker convinced him to transfer his savings to a brokerage account to day trade. And he told him stories about people making passive income or daily income trading on CFDs and spots, like in currencies, spot gold and oil and indexes and so forth. And he opened a 1 to 100 leveraged account. And this guy, pretty much, he didn't have any experience in trading. And he thought it would be easy, but he mentioned that he had some experience in trading stocks. But trading stocks is different from trading in the margin account. A margin account, pretty much you are borrowing money from a broker, your brokerage account. You're borrowing funds multiple times. If it is 1 to 100, means that it's 100 times your initial deposit. So that's a lot of money in the market. Anyhow, so he lost his $150,000 in a matter of 3 days, and he went mad. Psychologically, he had issues, and he got divorced. He was about to go to Canada for a better education for his kids and have a better life standards in Canada. And he had dreams with his wife, with his kids, to have a new life. Everything got shattered and all gone, and he got divorced, and all the dreams got shattered. So let's analyze what happened. So this is a learning lesson for everyone to understand the mechanic of the market, the mechanic of the trades. Um, no one should underestimate the learning lesson that will come out of this session. So let's get started. All right. So it's a day trading, and he traded on gold, and is based on real live trading account. His leverage was 1 to 100. Okay. So we're going to be applying our model again in order to analyze his trades and see and exactly what happened and where he went wrong, so that we all can learn from this. Again, is going to be based on our model, which is called the losing cycle. And losing cycle is based on negative EV, and we call it MPL curve, which is marginal propensity to lose. Why marginal propensity to lose? Because on a cumulative basis, um, you know the you know the cash flow has a tendency to go down. It's a losing cycle, and it's never a winning cycle. The cash flow doesn't go up on a consistent basis. On a consistent basis, it has a tendency to go down. Occasionally, there is a spike that might give you a hike in your cash flow, which we call it the MPL curve shift to the upward. So we will explain this. Obviously, if you have seen our previous video on how the person lost $80,000 in a casino gambling, and we explain how the whole negative EV curve operates in a casino environment. So this is a trading environment. It's a different behavior on the EV curve, and we will explain that. All right. So the model is about y-axis and x-axis. The y-axis is volatility, which is the volatility of the price action, and also the volatility, of your cash flow as well as you trade. And then the x-axis is the time frame. Now, this curve is the downward sloping curve, which we call it MPL, marginal propensity to lose, which is the same as negative EV. And this is a negative EV curve. And we call that marginal propensity to lose because, when you are trading, just like gambling, same thing, you have your cash flow goes up and down. So it's up and down, gains and losses, gains and losses, gains and losses. Usually what happens is that your losses are bigger than your gains, usually in trading and gambling. They're the same. So your losses usually are much bigger than your gain. Usually you are stuck in the losses for a while before it comes up again. And then you gain or you claim victory when your cash flow goes above this MPL line. We call that a zero line or $0 line. Whenever it goes up, you see a profit. Your bankroll is up. And there, basically, usually in a trading environment, you close the trade and you take profit and you claim victory. But in reality, it's not a victory and it's not a win. Why? Because it's just a normal wave on the MPL or negative EV curve. The wave meaning that it's you might realize small profit, a big loss, a small profit, a big loss. So why is it a negative EV? Because it's a negative expected value. So the expected value is to the downward because due to the downward pressure of your cash flow to go down because of this behavior of large losses and small gains. Sometimes, you don't realize this when you're trading, so you don't get out of small gain because you have seen a big loss. So you are in expectation that it might go even higher so that you can make more money and you stay put on your trade. But again, it doesn't really go up and then it goes down again. And then again, you are stuck on the trade. And then eventually you just get fed up and then you close the trade and, all sort of funny things happen. Okay. All right. So now this guy, he brought in $150,000. So, he started placing a trade. He initially placed a trade. And as soon as he placed the trade, guess what? Because of the spread, I mean, obviously, there is a buying price and a selling price. There is a spread. So as soon as you place a bet or trade, you will realize a negative value. That's about, let's say, $10. All right. Again, these numbers are real, and these are approximate figures, but they're not exactly the same figure as what he has experienced, but more or less is accurate. But these figures are all about approximation. All right, so as soon as he opened the trade, there was a negative $10 because of the spread between the buy price and the sell price, which is normal. All right. So as you realize, immediately once you open the trade, it's below this $0 line, which is the negative EV curve, which is the same as MPL, marginal propensity to lose. I mean, you're already you're already lost here, right? So all right. So basically, you are stuck now because now, I mean, it's not stuck, but, it's a natural negative figure because of the spread. And then you wait for the price of gold. I mean, he was short, and then the price of gold shot up the roof. All right. So it was a short trade on gold. All right. So, and this figure is actually his bankroll or his equity. So his equity came down by $10 as soon as he placed the trade. Then, all right, now here what we are saying is that this line is negative EV, which is equal to $0 line. So basically the price has to come above the $0 line to realize a profit. So you can't take profit unless the price come above this $0 line. All right. Now, his bankroll came down to 149,000 because somehow initially the price went up on gold. Since he was short, the price of gold went up, and his equity came down to negative $1,000, which is not really concerning. I mean, he has $150,000. So obviously, he has enough margin to cover this much of loss. So he waited hours. So basically, I don't think he had stop loss, and he just kept it open because he was very sure that the gold is going to come down because gold was sitting at the peak. That's what he said. I mean, it was sitting at the peak, and there was no way that gold was going to go down because it had a support. He support and resistance. He clearly saw the resistance line, and the price was basically going back and forth, up and down, in a range on the top. And he thought that there was a double top formation, and he took a short position on an extreme resistance line after monitoring. All right. So basically, he was sure that the gold is going to come down, going to come down. So, but it didn't. It kept, pushing higher from that point. So that's a negative $1,000. And then after a few hours, when he came back, when the U.S. session opened, he saw a sudden spike in the gold price since he was short, and so basically he realized a $10,000 dip, and his equity came down to $139,000. So now he started panicking. Um, I mean, that's a lot of money. I mean, in a few hours. I mean, that's a $10,000 dip. So right now, still, he is now what? He's now below this $0 line. So I mean, he can close the trade because he's now waiting for this price or for his equity to go higher than the $0 line. As soon as he realizes that the equity is going higher than this $0 line, he will immediately will close and take profit. But so far it's not doing that. It just keeps, his equity keeps going down because the gold price keeps going up. The next thing he found out, rapidly his account or his equity came down by $25,000, and his equity came down to $114,000. And then kind of a little bit bounced back up, but not enough bounce because it didn't really go above this $0 line. And he thought that that's a good sign, so he could wait a little bit, and then as soon as it touches the $0 line or a little bit above this, maybe he can take profit. But it didn't happen. So here, basically, there is a lot of things one can do, such as averaging up. They could take more position. Like if he had taken uh, a short position here, thinking that it's gonna gold is gonna come down since he's waiting for the gold price to come down. So he might have taken additional short at the higher gold price. But I mean, he could have. I mean, a lot of people do that because they just keep adding, thinking that the gold price will crash, so they keep adding on their positions, and then that could have um, made things worse, meaning that it could rapidly accelerate the losses. So in his case, the price went up to, I mean, it recovered slightly by $15,000, but he didn't close the position yet. So and then suddenly his equity dived to negative by $54,000, and his equity now went down to $100,000. So now he started with $150,000, now to $100,000, and then gold somehow kept going up and accelerated up. And again, in between, again, it bounced back up a little bit, but not enough, and it didn't cross the $0 line yet. Still is under the water. And again, it dived to, again, another dive by $50,000. His equity came down to $50,000, but that's a disaster. So at all of this time, he's not closing the trade. He's not taking any loss, wishing that because that's a lot of money, right? So by now he lost $100,000. There's no way that he's going to close the trade. Now he's like, he has no choice except to wait until the last second to see, if the gold can bounce and or can reverse back down, so that he can recover some of his capital. But the gold did not. At that time, gold was accelerating higher, and then another 30,000 loss, and his account went into liquidation. Now, what we learn from this is a different behavior than in the casino gambling. In the casino gambling, usually when you are betting, you will see a gain and loss, gain and loss, gain and loss over this $0 line. But in trading, usually that doesn't happen. It could happen if you are scalping when the price action is ranging. But if the price action is going one direction, such as the gold price was going higher, and you are short, obviously there is no way that the profit and loss will act with gain and loss, because in order to see the gain and loss, you need to see the wave over this $0 line. So in this case, basically it's just one way downward. So some people, what they do is they have other options such as averaging up. They do averaging up, meaning that they could put more money in and then they keep shorting as the price go up, so that the $0 line, that's MPL2, and so the $0 line comes lower so that he can take profit sooner than later. So basically, he's expecting, so one might bring the $0 line lower, or in his case at least, uh, uh, so that he can take profit sooner when the price bounce back at him. Like for instance, this one, the price bounced back up here. The price here also bounced back up. So in this case, he could add more capital and then take additional short, and then benefit from the bounces whenever, and then bring the $0 line a little bit lower. It's a risky thing to do, but some traders, they do that, and sometimes it works, sometimes it doesn't. But in this case, gold was accelerating much higher without stop, and it did not really kind of correct much. So it could have, it could be a very risky thing to do. And some others, what they do is they place hedges. That's a hedge line. A hedging is like locking the loss. So let's say this was the loss of $15,000. You place a hedge here, meaning that the buying quantity and the selling quantity are the same. So you place the buy and sell in the same quantity, and then lock the loss. And then you just step back and watch the market. You don't do anything until you are sure and certain, about the decision that you want to take, what the goal is doing. Until then, you just keep your losses as is, and then you decide what to do later. But these are different techniques. Again, it doesn't work all the time, but these are the things that you could utilize in order to manage your trades. But and again, this is just for the explanation. But what I'm trying to get to here is that in trading, same as gambling, you have this EV curve, which is negative EV curve, and you are basically going to be facing similar waves, but I find trading to be a little bit more dangerous than gambling, because there are so many different drivers, right? Some, like, you don't understand the market. There are market makers, there are liquidity providers, there are institutions and hedge funds. There are so many different variables that are playing, and you are basically, you don't know what they are doing. You have no clue what the market is. You have no clue what the market is up to. You have not enough information for you to take decision, and there is not even a clue, to predict what the price is going to do next. And trading, usually to make money, you need massive capital, and basically, this kind of capital to put into something that you don't know what you're doing is kind of risky endeavor. So basically, I suggest that if someone doesn't have much experience, not to deposit a lot of money in trading. Maybe you can try and play with $100 or $200 just to be in the market and use trading information in order to basically leverage from these trades in order to build a portfolio of investment elsewhere, just to basically to be in the market, not to make profit or day trading or trying to make an income from trading. I don't think it's a good idea. All right, so basically now that's the what happened to him, and this is how the EV curve I mean, unfortunately, this is how the losses occurred, and this is the behavior. There was no wave on the EV curve, but actually, his equity was constantly under pressure below the EV curve. So here it goes: minus 10, minus 1,000, minus 10, minus 25, minus 15, minus 54, minus 35, minus 50, minus 30. So overall, basically, the wave was under pressure below the EV curve constantly until ruin. Okay, so if we want to explain this phenomena on the EV curve, on the specific EV curve, how does it look like? So in a trading environment, unlike casino gambling, so basically, let's say these are the incidences. Usually, this is how it looks like. So basically, you have, constantly, the moment you open a trade, you don't see the sunlight. I mean, you don't see a profit above the $0 line. Usually, you go into a loss. It could bounce back to your $0 line, and then it comes back down again. So there is a double bottom here, and then there is a fake out here. And then this is basically, it's called crowding out or shaking out. So basically, what's going on here is that the market makers, they have artificial intelligence and algorithm, and they know basically all the traders where they have opened the positions. So what happens is that they know the $0 line where they are placed. So constantly, basically the price is under pressure below the $0 line, and then barely it touches there. And if the traders don't get out here, basically it goes back down, and then so that's a double bottom, and then there's a fake out here, and then this is called uh, the what do you call this? The it's not a discount zone, but it's called the demand zone or something. But anyhow, this is where the block is, where they try to liquidate accounts. Okay, and then once the accounts are liquidated here, uh, uh, once the long or shorts are covered, basically, and then you will see, the equity, if you are still in a position, it might go back up again above the zero line, but it will take some time. So you'll end up waiting on your position for a very long time until you realize some profit. So your equity behavior under the EV curve, when you are trading, it looks like this. It looks like this W curve. It goes down, it touches the $0 line, it comes back down again, and then it goes back up again. So accordingly, you need to manage this trade by taking very small positions, and also you need to manage your margin. I mean, 1 to 100 is way too much. Maybe 1 to 30 or 1 to 50. I would suggest 1 to 30 leverage margin, and also take small positions in order to ride out these waves and as you take trades in the financial markets. So that's the only way to basically, you can cover your back and ride the wave of the volatility in the financial market until you realize some profit. And once you realize a profit, as we said, once the equity goes above the $0 line, it doesn't stay there for a long time. It goes back down again. There's a losing streak going to come. So before that, you need to take the profit, close the trade, and then wait before you come back into the market. It might take another 1 or 2 weeks before you need to come back to the market. Scalping is very dangerous because scalping, basically what happens is that the moment you take profit, you take another scalp. And usually it turns into major losses if you do that. So whenever you take profit above the $0 line, you have to wait at least 1 week before you come back and trade with a better plan, with a better decision. Guys, I hope that you have learned uh, from this lesson, and I hope that you enjoyed this video. And until the next video, ciao, and please do not forget to subscribe to our channel and press the bell button.